What's going on, everyone? And welcome to episode number 4 of the Migrate Your Money podcast. I'm your host, Jeremy Crocker, and alongside me today is my co-host and certified financial planner, Drew Fights. In today's episode, we ease in with one of my most recent outdoor adventures, and we even get a glimpse of Drew's countryside as he talks about one of his adventures as well. We then jump into the main topic for today, which is you should expect the market to crash at some point. Now, this isn't meant to scare anyone. In fact, it's the opposite. We'll dive into some facts and some figures from over the years that shows the results of maintaining good behavior during both the good and bad markets. We also talk about the difference between fees and fines and how we feel you should approach them. So without further ado, please enjoy this episode of Migrate Your Money. So I've got a good story for you. So,
all right, let's hear it.
All right. Have you ever been morel mushroom hunting before? Have you ever heard of it or anything like that?
Yeah, I grew up, like, my parents have 20 acres. We did that all the time.
All right, cool. By the way, you got to check your property too. I was thinking about this last night. I'm like, man, they've got to have something on their property. Like they've got to grow on the banks.
I know people around here find them. I went back there once a couple weeks ago, but I didn't find anything. So
you got to go now. Now's prime time. Nice heat. It's warm out. It's perfect. So anyways, I'm fairly new to it. I'm a little bit of a rookie. I started last year and I found
you never had gone before that?
Before that? No, never.
Really?
It always falls on like turkey season. So I'm always like turkey hunting or something like that.
Okay.
And then like my brother's never, he's won a couple times, but he wasn't really like into it that much. So last year I'm like determined to find one. So I went out 2 or 3 times and found one the whole year. And then this year I went yesterday, actually last night, was like, you know what, I'll get out for an hour or 2 hours. So then I ended up walking 4.5 miles. I tracked it and I found 3. And last time I'm all excited. I come home, I'm like, look at this, Anna, like we're going to be eating good tonight. So
yeah,
we sliced them up and ate them last night, but man, they're good. I can 100% see why people like them so much.
See, you are a rookie, because what you're supposed to do, you cut them in half, put them in salt water and let them sit overnight, because there's all kinds of bugs and stuff in them. You just ate like all the bugs from the woods.
Yeah, I know. I found out afterwards. I'm like, you know what? I probably should text someone to see what I should do. I texted my friend Nathan. I'm like, hey, what do I do with these? And he said, yep, soak them in salt water. Like make sure all the bugs get out of them. I'm like, there's no bugs in there. He's like, there are.
Just because you can't see them.
Yeah. Like, well, hopefully I don't get a parasite or something like that. So I'm all good so far. We'll see though. Might drop dead tomorrow. Right. But
all right, should we actually get into this?
Yeah, I think so. I think let's go into this one. This is an exciting one. So
glad to hear about your 3 mushrooms.
Yeah. Hey, it's a start.
All right, so let's dive into this. So kind of like what we're gonna name this, I guess, is something along the lines of you should expect the market to crash, right? So
right. Which is awesome. That's hilarious. I'm sure that's going to be real knee-jerking.
Yeah. So we're recording this at the beginning of May, and I don't think it's on our calendar to start promoting this on social media until sometime next month, but I still think that's okay. Don't you?
Yeah, I think so. I mean, so this is a topic that I think is something that's relevant at all times. And I think it's especially relevant when the market's doing really well, which might not be the case right now, but I think it's relevant at all points in time. So yeah, I think it'd be perfect, honestly.
Yeah, I agree. I mean, unfortunately, the market hasn't done really well this year. As of the market close on May 3rd, the S&P 500 was down around 12%. So maybe not the best, but you know.
Yeah. That I mean, kind of has to be expected though, right, Drew?
Yeah, absolutely. But what do you mean by has to be expected?
So, you know, you said the S&P is down, but so the S&P, it's not a perfect gauge, but it's you know, something that we're going to be talking a lot and mainly about today. And for those of you that don't really know what it is, so the S&P 500 it's a stock market index that measures the performance of the 500 top publicly traded U.S. companies. So pretty broad range, I guess you could say. And really, like based on history, and I'm going to pull this stat up here. So we should expect the market, and we should expect, the S&P in this case to decline sometime during the year on an average of 14% every single year. So that's kind of crazy when you think about that, honestly.
Yeah, no
and
doubt.
then and then even though it's the case, like between 1980 and 2001, the annual returns of the S&P they've been positive 32 out of the 42 years. So that's 76% of the time. So when you break it down in percentages, that's actually not that bad.
Pretty good.
Yeah, exactly. It's crazy when you break things down in percentages. When you see numbers, you're like, holy cow. But then when you put it into percentages, it's like, I mean, I can see that for sure. So
yeah.
And really, I mean, to break it down even more, and to break it down, I guess, and just to be more clear. So that's a massive decline, right? And especially within the year. So, but like we said, historically, the S&P 500, it's been positive most of the time, despite that decline happening throughout the year. If that makes sense,
Yeah, for sure. And I think we had a really good example of this just a couple of years ago, right? In 2020, the S&P dropped 34% from February to, I think, about March 23rd of 2020. 34%. Just imagine. I mean, most people probably aren't or shouldn't be invested just in the S&P, but imagine 34% of your money is gone within a month.
Yeah, that's wild,
crazy.
Man. Yeah.
And then during that time on March 16th, that one day, the S&P dropped by 12%. And the Dow and the NASDAQ, which are other stock market indexes, also fell over 12% that same day. Like that's a scary day for people, But
yeah, I mean, especially people that are close to retirement too, right?
Yeah, for sure. I mean, hopefully they're not that heavily invested in the S&P or the Dow by itself or whatever. But yeah, absolutely. Seeing your portfolio go down when you're thinking, okay, this is what I'm going to live off of, that's scary. But so it lost 34% in about a month, right? 12% in a day. But despite that, the S&P 500 ended 2020 positive over 16%. Like, so that's just a prime example of what you just explained about how on average it can decline 14% in a year, but 3/4 of the time it ends the year positive.
Yeah, that is wild, man. That's wild. But so I'm a big Morgan Housel fan. And as of you are as well. But
yeah.
So I'm gonna pull up his blog post because I really like how he explains this. So the blog post is titled "Fees and Fines" and it's from April 2nd of 2019. And he starts like this. He starts by saying, "The last 3 months of 2018 was the worst quarter for stocks in 7 years. However, the first 3 months of 2019 was the best quarter for stocks in 10 years."
That's crazy.
That's crazy to think of too. And then he goes in and talks about fees versus fines. And what he says about this is that he says fees are something that you pay for admission to get something worthwhile in return. And then he breaks down fines as saying fines are punishment for something that you do that's wrong, right?
Yeah.
So we should think of the declines in the stock market as fees rather than fines, right? We shouldn't think of them as fines. We shouldn't think of them as us doing wrong because the market might have dropped or we might have, lost a little bit of the gain or whatever. Because when your portfolio is dropping due to the market, I mean, it's not a fine. It's not. So that's the fee that we have to pay to obtain those long-term gains or those long-term increases in our portfolio overall.
Yeah, absolutely. I think the fine would be if you made a decision that wasn't aligned with your long-term goals, and maybe like you saw the market going down and you sold out, and then you miss all the upside, right? Like what was the start of that again? It was the last 3 months of 2018 was the worst quarter for stocks in 7 years. Imagine if you sold right there. That's your fine, because the first 3 months of 2019, the next quarter after this worst quarter was best quarter for stock in 10 years. So that could be your fine. But if you maintain your long-term like investment strategy, then like you said, it's just a fee, right? It's a price that you have to pay to get those returns.
Yeah. We should really look at it as like the inverse, honestly, because people think when they're pulling their money out, they're like, oh man, I gotta get out. But really that's kind of the fine, because you're not being in there long term.
Yeah,
You're
exactly.
pulling out. You're freaking out and you're pulling out your money and everything. So
yeah, I really like that article that you're talking about. In that same article, Morgan Housel compares market volatility, or I mean, we're kind of talking about it as market decline. So I guess market volatility may be a little bit of jargon that I shouldn't use, but he compares that to paying for tickets to Disneyland. So people go to Disneyland and there's a fee to go, right? It's the price of a ticket. But people see that as being worth paying because of the experience that they receive when they go there, right? They go with their family, take their kids have a great time. They go ride, see princesses, see Mickey, all that stuff. And like the fee was worth it, right? So I think, like you said, it's better to think of a stock market decline as a fee. And kind of sticking with the idea that Housel lays out in this article, you could take your kids to the county fair and it'd be a lot cheaper than going to Disneyland, right? That's kind of what he writes. But the experience would be way different, right? It might not be that magical, I guess, air quotes, right? Because that's kind of what Disneyland's supposed to be. It might not be that magical of experience, but it'd be way cheaper. So kind of in this analogy that we're using here, the stock market is like Disneyland and the county fair might be something like cash, right? You don't experience that volatility, those declines in cash like you would in the stock market. But if you want the higher returns that you get from the market, they don't come free, right? The fee that you have to be willing to pay for those higher returns that you get through stocks than what you would get through holding cash or something else is kind of the greater volatility, the greater uncertainty, the bigger declines at times that you have to go through.
Yeah, no, most definitely. And it's going to be scary, right? Like you said, you mentioned a little bit earlier, but it's really hard to see your portfolio losing money, and in the mass amounts that some people do see it, it's even more difficult. So, and again, too, there's always going to be like a different reason to think, I need to get out, right? Or it's this time's different. Like, I understand it this time. Like, I've already seen this once before. Like, we got to get out. And so there's a slide from Dimensional Fund Advisors, and I want to link this to the show notes, and also for the YouTube, for people that are watching it. I want to bring this into the video to show them as well. But so this slide is titled "Markets Have Rewarded Discipline," and I like that a lot, because what it shows a bunch of different reasons throughout history that people like might have thought, hey, let's get out of the market. Yeah. I mean, one can be, like you just said, in 2020, COVID-19 pandemic. You've got Brexit on there. You've got, the Eurozone debt crisis. You got the Great Recession on there, the subprime mortgage crisis, all that's on there. But historically, if you look at it, and of course, we should probably plug in the disclaimer, right? Past performance isn't indicative of future results, but the markets continue to reach all-time highs as long as you continue to look at it overall.
Yeah, for sure. And it's crazy to look at one of these charts like this DFA one that we have here and look back. This one goes back, it looks like, to 1970, and all these things that were like being, I don't know the right word for it, but being thrown around in the media as it's like the apocalypse of the day, right? It's the worst thing that's going to happen. You're going to lose all your money, this type of stuff. But the chart just keeps going up and to the right. I mean, there are dips at times when some of those things happen, but like you said, the markets just continue to reach all-time highs despite those.
Right. And I think it's hard for people to, like, he mentions it, and like, even, I'm going to quote the Jocko Willink, but even like Jocko mentions like discipline, right? Discipline equals freedom. Yep. That comes from everything. Like, it's crazy on just maintaining the discipline of investing, making sure that you're continuing to add to your portfolio and not freaking out in times of trouble, I guess. It's very, very hard, right? But discipline equals freedom.
Yeah, I think that's a great point. I think we've probably done a pretty good job of letting people know, that they shouldn't necessarily freak out when they see the market go down, when they see their portfolio decline. But what do we do with that information? Well, I think maybe the first thing is, like you said, discipline equals freedom. So we need a strategy in place, right? So that could be an investment policy statement that says, hey, here's how we're going to handle our portfolio. Here's how we're going to manage it. Here's when we're going to trade, right? We're not going to just trade whenever we see the market doing scary things. We're going to kind of have rules in place. I also think it's important to have a diversified portfolio, right? We've been kind of talking about the S&P just because that's a good gauge that we like to use. You know, it's 500 of the biggest stocks in the US. It's clearly not, you know, like an extremely diversified portfolio. But if you had all of your money in the S&P and it goes down 34%, well, that sucks a lot. But if you have it diversified across, you know, the S&P, which is large cap stocks, small cap stocks, international stocks, emerging markets, real estate, bonds, all these other things, now you're not going to see those giant declines that you might if you were just had all of your money in one of those things.
Yeah.
So, and I think it's really important to consider your personal situation. And this kind of goes back to that investment policy statement that I was talking about. But someone who's young and has a long time until they need to use their money, they might be able to have a riskier portfolio. Someone who's older, like you kind of mentioned earlier, and they might need the money sooner, or they might be already retired and they're drawing on the portfolio. Well, they should probably have a less risky portfolio, right? They should probably have a bucket that they can be like a safer bucket that they can be drawing funds from. But like you said, I think at the same time, a lot of times we hear people who are either nearing or in retirement who are worried about stock market volatility. And I think it's really important for those people that they are in an appropriate portfolio, right? And that they're maybe not invested 100% stocks, definitely not 100% in just the S&P or one index like that. If you're drawing funds from your portfolio to pay for your lifestyle, then you need a safer bucket that you can pull money from that isn't so volatile, that isn't likely to drop 12% in one day, you know?
Yeah.
And I think it's also important for people who are nearing or in retirement to consider their investment horizon. A lot of people think, okay, once I get to retirement, now I'm not supposed to be invested anymore, right? No, you need to be invested through retirement. Right. I mean, if you retire at 65, you could have 30 more years to live that you need to pull the money from. And if you just let inflation eat away at cash for 30 years, then you're probably not going to be able to fund your goals and your lifestyle. You know what I mean?
Yeah, and that's a really good point too, because I ran into it multiple times where it's like, I mean, the goal is to, I mean, when you're talking to anyone, it's just like, hey, I'm looking to invest for retirement. And I'm like, that's awesome. That's terrific. But we're looking to invest in retirement. Yeah. But we're looking to get you past retirement. We don't want you to just have money for at age 62, I have X. Like, no, you're, like you said, you're going to be living for 20, like, who knows? So the goal is not to get to retirement. It's to live past retirement and not have to worry about working to continue to supplement your income because you don't have enough.
Yeah. And I think maybe more relevant for some of the people that might be listening to this, kind of our target audience, I guess. Yeah, you probably need to be more aggressive in your portfolio. And again, this all goes back to depending on your personal situation, your goals, your time horizon, all these types of things, right? But you might need to be more aggressive. You might need to be willing to be able to withstand a lot more of that volatility, a lot bigger drawdowns. But then that's part of our job, right? Is to help people understand these are the possibilities. It's likely that these bad things could happen, but we're investing for the long term. And if we don't take that fine of selling out, going to cash, whatever it might be, then we're just paying a short-term fee for greater long-term gains to help us reach our goals.
Yeah, no, I agree. I certainly agree. So, man, we talked about a lot in this one. It was a quicker hitter, but I kind of like these, honestly. I mean, this is something that we mentioned at the beginning, but it's relevant, right? And it always will be relevant. I think if you're an investor, it's relevant because at some point in the time you're going to see a crash, a correction, whatever that might be. So, what else? You have anything else to add, Drew? Or
no, I think we were pretty long-winded in the first 3 podcasts that we did. So it's probably good to throw out a quicker one that, like you said, I think it's really important. Yeah. Quick hitter. I think it's really important. Hopefully we gave some good information, some things for people to think about, but I think probably good to go on this one.
Perfect. Well, then I'll end with this. I appreciate, for those of you that are watching on YouTube, or those of you that are listening on all the platforms, I appreciate it. Thank you for that. If you found this beneficial, of course, please like, share, subscribe, send this to anyone that you think might be relevant. And just a reminder for you that, we specialize in providing fee-only planning and investment management for, people in their 30s and 40s. And again, if this sounds like something you're looking for, you can visit our website. It's migrationwm.com. There you'll find all of our social links. You can follow us on all that as well. But if you did want a free meeting, just go ahead and scroll down to the bottom and click request free meeting. And again, as you could tell from this episode, we're pretty relaxed. It's no pressure. All we're really looking for is just an opportunity for us to learn about you and what you're looking for. And then for you to kind of get a gauge about us and see if you like us, give us a chance to explain more of what we do and see if we might be a good fit for one another. And of course, if not, completely fine. We have no issues of referring, to different advisors or whatever that might be. So
this podcast is for informational and entertainment purposes only and should not be relied upon as a basis for investment decisions. None of the information provided in this podcast is intended as investment, tax, accounting, or legal advice.